Shridatta Bhandwaldar, who is the head equities at Canara Robeco Asset Management Company. And Shridatta, if I talk about, is a management graduate specializing in finance and has a rich experience of over 16 years in Indian equities.
Oh, it's interesting to start. Good evening, everyone. It's interesting to start, and when you look at your first slide, you find a grammatical mistake. It's very interesting. There is a grammatical mistake on this, and there's, again, no hamper for finding it, but most of you would not have noticed it clearly. So, actually, when this topic was given, I have already cut it a little short. I was thinking, when you talk about insights in equities and insightful perspective on equities, there are two aspects to it. One is basically, I can go and say, okay, basically, I start with a prescriptive kind of approach where, oh, long-term investment is good, compounding is good, you don't lose money first, so you'll always make money and stuff like that. That's one way to look at it. Second is more practical approach, which when you go back tomorrow and start your business, you'll need it. And I thought, let me go with the second practical aspect, which we use in our job on day-to-day basis when we manage our funds. That's a more application-oriented perspective. That's a perspective which you can actually use to make money. And I have chosen that perspective, whereby how do we actually look at equity markets at all point in time? Every month, every quarter, we meet people and they ask, okay, what is view on market? How are you approaching the market? How are you looking at market? What is happening to this sector, that sector? The basic structure of how we look at markets never change, actually. There are only 4 aspects that we look at any given point in time when we look at market, and this is not the prescription part. Those basic tenets are in place, but how do you look at the market? And I realized that there are only 4 aspects that we consider. One is, and I'll come to why we actually consider those, and I actually created a case study of market outlook to just explain those parameters, basically. So first is global macro. See, post the Bretton Woods system, we are far more integrated than what we were ever. And to that extent, the capital flows in turn has both the ability to impact the valuations as well as the ability to impact earnings themselves. Look at what has happened over the last 18 months, and I'll come to that once we start the presentation. So that's one factor. Second is, the second part of the system is domestic macro. I mean, you are operating in a system, and every system, whether it is a particular country or a second country, every country has its own system in which the companies are operating. If their regulators, if their actually the infrastructure, if their frictional costs are far higher, they might not be able to operate in a particular way. So the second aspect is what is happening on domestic macro, what is the system in which they are operating, and what are the parameters that we should consider while actually looking at the second aspect. Third is, and which is the most critical, which we say that it is the gospel truth for fund managers like us, which is basically what is happening on bottom-up basis, what is happening to the earnings, what is happening to the corporate profits, because that's the holy grail of markets. Any stock, as you extend the time, if you actually plot a correlation between the stock price performance and what has happened to the profit growth of that particular company or earnings growth of that particular company, there is absolutely no deviation in it over a period of time apart from just valuation re-rating. So that's the third aspect. And fourth is basically your valuation and how do you look at valuation. So I thought that rather than giving a prescription of lot of basically traits, let me take you through a case study as to today, if I'm sitting here, how am I looking at market in these 4 compartments? Because this is what you can apply in your day-to-day life. This is how you can look at the markets. You don't need to ask a fund manager as to what is going to happen in market. This is very simple. Anybody who has even an inclination to read, because it's idea-based, anybody who has an inclination to do research and read for say 2 hours a day or 1 hour a day will be easily able to form his own view, rather than actually asking it to somebody else. And that's always a good thing, correct? When you are self-dependent in terms of helping your client by forming your own view, your conviction will be different because, as they say, you can never borrow somebody else's conviction in this business. So let me start with the presentation. So this is the case study that I have created. This is like an equity outlook, but in each of the parameters, I will actually explain you. So what is happening on the global front, what is happening in the domestic, what is happening to the earnings and valuation. Those are the 4 parameters. Then, of course, there were specific requests from, I think, a lot of people as to how are you looking at mid-cap versus small caps, and how are you looking at basically when an individual IFA or an investor looks at a fund, how he should look at, what are the parameters which are behind the returns. Basically, looking at returns and saying, okay, this fund is better than other is a very, very easy stuff to do. But whether those funds will over a period of time have the traits to deliver that or not, that is a function of when you go behind the returns. And that's the last part of it. Those are the additional 2 parts. But the initial 4 parts is a case study of how you go about looking at it, and don't go back and ask fund managers or anybody as to what is going to happen in market. So the first part is basically the global macro. In global macro, just look at what has happened in last 18 months at a glance. In last 18 months, you had unprecedented amount of fiscal and monetary push that was given, which led to huge US savings, which led to huge money supply globally. And in turn, when this kind of expansion of money supply happens, both on fiscal side and monetary side, what you get effectively is a huge reflation. And you got reflation over last 18 months, which is reversing now, whereby the trade cycle started, the price cycle, which is inflation, showed up in commodities, and capital flowed into most of the emerging markets. And this is exactly what you experienced over last 18 months, which is set to reverse. I mean, this was the policies kind of amount of money that was thrown at the economies. And this led to the explanation that I gave in the first slide. This is set to turn. All this is set to turn, and we have been saying this for 3 months, 4 months now. You have reversal of balance sheets. And as the broad money supply, which is the macro part, and this is very simple actually if you spend some time. As the money supply reverses, most of your commodities and the trade activity reverses. And as it reverses, you will have moderation or normalization of growth. This is the first aspect that I wanted to explain, that when you are operating in a system, why you need to look at the global perspective is that what is happening to flows, and what is happening to flows is a function of what is happening to the fiscal and monetary policies. And that's what exactly is the first part, basically. As things stand today, the fiscal is going to get reversed. The interest rates are going to go up. Of course, geopolitical is the extra part that has come in the equation. But nonetheless, the liquidity is set to reverse. And what liquidity does, why one needs to look at liquidity or global flows, is basically there are 2 components to stock price or any market's valuation, market levels. One is earnings, and second is the valuation. And valuation re-rating and de-rating beyond a point is a function of what happens to the liquidity. And as this reverses, you already are witnessing the first part, whereby you are witnessing the reversal of the valuation parameters. So the earnings have not changed. The underlying GDP growth, the rate has not changed. As you can see here, that most of the countries still continue to report the kind of GDP growth which you have not seen. So if you look at the global numbers also, 6% last year, even 4.5% and 4%. These numbers we have seen last time in probably when I joined my career, 2015 to 2005 to 2008. After that, we have never seen these kind of numbers. So growth is intact, but the liquidity is reversing, the saving pools are reversing, and so valuation, which is the first parameter of macro, which is reversing. And that's what you are experiencing in last 4 months in market, that any market has 2 parts. One is core earnings growth, and how much the market is willing to ascribe valuation in near term, and that is defined by what kind of liquidity is available, and that is set to reverse. And this is where the first part basically ends. And this is a summary. Actually, you can take the picture of this, because this is interesting. What these earlier policies led to was basically suddenly you had capital flows towards emerging markets. You had basically commodities doing well. You had surplus banking liquidities, which led to stable currency, strong capital flows. The cost of funds have just collapsed. And you experienced that IPO raising that happened. Cost of capital just collapsed last year, last 1.5 years. So you had huge high valuation IPOs coming in. So effectively, entire balance sheet repair of the corporates in the emerging markets happened through these policies. It is set to reverse. Thankfully, it is happening after 18 to 24 months. So you have a scenario when you look at it, put it in the context of, say, let us take example, and this is not recommendation by, look at Tata Steel. I mean, Tata Steel, if you had asked Tata Steel management last year, probably in June 20, will they be able to reduce debt by 70,000 crore rupees? They would not even dreamt it, but it has happened. So, but as it reverses, you are going to have, these are the implications. You are going to have moderation in exports. You are going to have moderation in EM flows, which you are already experiencing. You are going to have liquidity moderation. And the consequence is the valuation multiple correction gradually. this first leg has happened. This is the most important part. This first leg has happened. This is why we discussed the first 4 slides. This first leg has happened. The second leg will play out if these policies and geopolitics actually persist for a longer period than anticipated. As of now, there is no earnings impact. So this is the first parameter. I'm just taking you through the case study. So why one should look at the flows and global context. So this is the first part of the perspective, which is a very practical perspective that I'm giving you. Now, there are a lot of people who keep asking this question, and this is the last slide on the global part, is basically whether inflation is good or bad for equities. Stock valuation is always a function of basically 2 aspects. One is discounting rate and earnings growth. The discounting rate is changing, where you are experiencing correction in valuation, but the earnings have not changed. Inflation up to a level is very good for the equities because it adds to nominal GDP growth rate, it adds to the inflation in P&L of the companies. So, but nonetheless, over a period of time, how markets will do or how equities will do is a function of both what happens to the underlying earnings growth and what happens to inflation. Just inflation being high or interest rates being high doesn't mean the market will collapse. So in US, interest rates are increasing, but it doesn't mean necessarily that market will do bad as long as the growth rate remains where they are. Coming to the second aspect. So when we talk about, so first aspect which we covered was global macro. The second aspect is the domestic part. So I'll just briefly cover this. There are only 4 components to the market, and I'm just explaining it in lay terms so that because I have decided to keep it more application oriented. There are only 4 parts to any economy. Let us not get into the complications. One is households, second is exports, third is government capex, and fourth is private capex. These are the only 4 key stakeholders in any economy. Now, at any given point in time, like I know, even if you are reading for an hour or so, even on daily basis, or reading the newspapers properly, you'll know what is happening in each of those segments. The numbers are available everywhere. So when you look at today's context, and since this is a case study, we're actually taking you through today's context. What is today's context? Because of the kind of internal cash flows and balance sheet repairs and liquidity availability over the last 18 months, you have unprecedented improvement in the balance sheets of banking system and unprecedented improvement in the balance sheets of corporate India. So if you look at the corporate India and the banking balance sheet, it was never in this shape. I mean, since 2013, both the corporates and banking system was struggling with either NPAs or high leverage, which is set to change. And that got accentuated because of COVID. So that's one aspect, which is the private capex. What can happen to private capex is a function of what is happening to the balance sheets of banks and what is happening to the banks' balance sheet of corporates. And they are clearly in a very, very healthy shape. I mean, they were never in this shape in last almost 8-9 years. And they have come clearly. So that's one compartment, which is what is happening to the private sector balance sheets and what is likely to happen to capex. So you can very easily make a judgment that directionally, as these guys have built a very strong balance sheet, they will eventually spend money. So OPEX will start, the capex will start, direction is clear. So that's one component. Second is governments. I mean, government. What is government doing? Again, government has been very, very focused on capex. Government's capex has been growing at 8 to 10% or more for last 4-5 years. And even in a tougher year like COVID and this year, if you look at the budget, they are still growing their capex at 10 to 15%, which again indicates that the second part is also in place. So you have governments who are doing capex, might not be, they have limited ability to do it, so they are doing within their ability, but it is still growing at 10 to 15%. You have private sector, which is in a pink of shape in terms of balance sheet quality. So those are the 2 components which we have covered. Third is basically exports. Again, in exports, particularly for India, we have IT, pharma, technology companies, engineering companies, which is very large part, and the external environment is still very, very benign. So you are going to have basically growth flowing in there. And last is actually COVID have had 2 kinds of impact on economy. One is the 80-85 crore people at the bottom of the pyramid basically who have suffered and who continues to suffer, whereas the guys who matter from listed space perspective in terms of value, those 15-20 crore people have only ended up benefiting out of market appreciation, real estate appreciation, as well as the kind of wage inflation that you are experiencing in IT and a lot of other sectors. So again, this parameter is doing kind of fairly well. So those are the 4 parameters that I wanted to cover. I'll just actually run you through the data points supporting this. This is the breakup of capex. And these are the parameters. Households, real estate has come back to more than pre-COVID level. The consumption is doing well at a higher end, which is the factor that I was explaining. The government capex, central and state both, is doing fairly well. The corporate profitability is set to change. Their balance sheets are in extremely strong, kind of under-levered or very strong position. The IT sector, the IT sector itself will add significant amount of labor force every year for next 2 to 3 years based on the kind of ordering they are getting. And this is the exports which we actually just converted. This is a CS, Credit Suisse, thanks to Credit Suisse. So how exports is likely to pan out over next 2 to 3 years. So these are the 4 components. So just to summarize, these are the 4 components of domestic macro that you have to look at. What is happening to households, what is happening to exports, what is happening to government capex, and what is happening to private capex. And you can make a judgment of in which direction we are moving. We might not be able to make a judgment as to what exactly will happen, but at least you know that it is happening, it is moving in the right direction, all 4 parameters. I'll just keep it given the, I think, this is an important slide. Typically, when corporate balance sheets are good and banks have actually passed through the NPA cycle, you are going to get credit cycle, growth cycle. The pace can differ, but the direction is very clear that you are going to get into a growth and economic cycle. And this is the summary of the first 2 parts that we discussed as to what is happening on global macro and what is happening in the domestic macro. Basically, you had global demand, which is strong, moderating now, USD, which was weakening, now strengthening, and so on and so forth. And last 4 parameters is what I just explained you in terms of what are the stuff that you are supposed to look at when you form your own view about the markets. This is the third part of the presentation, which I said, which is basically earnings and what is happening to earnings. That's the basically and most important parameter in terms of when we look at the markets and look at the first chart, and that is the most important chart, or this chart, last chart. Basically, the earnings, what used to happen since 13, every year the analyst will start with the earnings projection and will end in down, anywhere between 10 to 20% downgrades in earnings. From last 1.5 years, since 2021, you are getting the earnings upgrade and you are completely into earnings upgrade cycle. Both. The only thing is the earnings upgrade cycle is moving from externally focused sectors, that is export-oriented sectors, to domestically focused sector, which is what your macro is telling also you. So you are going to have banking, industrials, discretionary. Those are some of the sectors where you are going to experience earnings growth. And as I'm repeating, this session is actually giving you a case study so that you can form your own view, in terms of which sectors, which part of the economy is doing well. So it clearly indicates that, again, the earnings upgrade cycle is there, and this is where your earnings are going to come in over next 2 years. Clearly, the domestically focused sectors are on the right side of the curve, whereby you are going to experience significant earnings upgrade there, and that's what even the markets is telling you in terms of how sectors are behaving. This is what I was telling you, that basically the earnings are tilting towards this side. So this was the earnings part. So the earnings have clearly moved from externally focused sectors to domestically focused sectors. And last part is basically valuation, and this we have been saying for almost 4 months, 5 months now. The valuations were running ahead of the fundamentals. There was too much of discounting that had happened. How do you look at valuations? You just basically, easier one rather than looking at PE is basically you look at the yield gap. And if yield gap is the way it is, when it turns inwards, that's the point when typically the market becomes most attractive. So which is what is shown. So what is this yield gap? You just calculate the PE by reversing 10-year GSEC. And you take PE of Nifty and you reverse it and calculate the gap of it. The gap, once the gap starts falling below 100 bips, 80 bips, that's the point when market starts turning very, very attractive in terms of valuation point. And it has never failed. In fact, when you buy it reverse, you make disproportionate amount of money. So there are 2 or 3 instances where the market has the yield gap has reversed, which is 2008, 9, then 2013, I guess, and now in 20. This was the question which organizers asked me to address. Clearly, small caps and mid caps are trading at a premium as compared to historically where they were trading as, and the benchmark that I have taken is Nifty because you have to take some benchmark. So if you look at the mid cap category, most period barring probably 13, 14 and part of 18, the mid caps were trading at a discount, sizable discount to large caps. They have moved into premium. Same with small cap. Most of both these categories have moved into premium. And typically we have observed that whenever this premium comes, you can always get a story, but those premiums sustain only for 6 months to a year if it is really a constructive environment. Nonetheless, the disclaimer here is you have to still look at the earnings of those individual segments. So if you are really going to get an economic cycle or credit cycle, and if you get a very strong tailwind on domestic side, you might still get this kind of inversion for some more time. But it has not worked in the past. So these are the flows just. Probably this is the most important slide from your perspective, given that you advise to a lot of people as to how does one look at the portfolios. I think when I invest myself, I give the most amount of weightage to what kind of basically risk-adjusted a particular fund is making, and how do you look at risk-adjusted returns. 2 or 3 parameters. One, you look at the downside deviation, which also gets captured in Sortino ratio. You look at standard deviation, and the most important is you actually pull out the data for that particular fund over 10 years and look at, if assuming the fund manager is same, or 5 years, whatever that fund manager is, just pull out the data and see every time market fail, say 10%, how much that portfolio fail. That gives you don't have to ask anybody, that just will tell you what kind of portfolio construction that particular fund manager or a house does. So that's the most important parameter that we look at internally when we construct and every time market corrects, because it's very easy to get carried away and form a very, very aggressive portfolio. But through the cycles, if you have to get compounding, you need downside protection, because most, in fact, 90% of the successful fund managers are the ones who actually avoid drawdowns during bad phases of market, which can extend for 2 years, 3 years sometimes. Then second is portfolio turnover, frequency of particularly change of names, how frequently the names are changing. That tells you what kind of conviction they have in what they buy. Of course, you will have changes in names, but at what frequency it is happening. If it is happening too fast in a particular portfolio, it clearly indicates that it is just trial and error. There is no thought that is behind the construction of portfolio. Then return attribution. So there are 2 ways to actually, this is very interesting, probably you wouldn't have heard this a lot. There are 2 ways to actually create returns. One is allocation and other is selection. I'm a big votary of selection because you pay an active fund manager or you invest in active fund management for selection, because allocation is a strategy which works in a particular cycle or works for a very short period of time. But if allocation is what a forte is of a fund manager, and it's not that there are no fund managers who can actually consistently deliver alpha based on allocation, there are certain, but allocation actually reflects in portfolio churn, and allocation actually adds to risk of portfolio significantly. When you do selection and when you have better selection, what it effectively means is that if I almost construct a portfolio equal weighted across sectors, and if the selection is good, I should be able to generate alpha every 3-5 years. Of course, it will not happen every 1 year or 6 months, but every 3-5 years, if your selection is good, your alpha should show up after fees also. And that's where I think you should look at the attribution from the perspective of if any fund has outperformed significantly in a year or 2 year or 3 year, where the alpha is coming from. Is it coming from selection or is it largely coming from sector की boss banking चलने वाला था, banks में 35% के बजाय 45% डाल दिया, return आ गया. But that is only one alternate history. It's very counterintuitive, but they call it as alternate history. If the other path plays out, if the risk plays out, then that fund would have underperformed massively because of that allocation. Then concentration of illiquid securities, and this is very interesting. Some of my colleagues are also there. In every presentation, we tell investors, don't look at NAV. Look at the underlying liquidity of that NAV, because you can get concentrated position. And there was one of the mutual fund, without quoting, I can tell you that they had bought 7% in future retail in last cycle, and their performance for a year was very good, but then you know what happened to that stock. So what kind of stock, what kind of liquidity that stock has, what kind of business it is there, and what kind of concentration of that particular security is there in that portfolio becomes very, very critical rather than just looking at anyway returns. Then last two are, last one is my favorite, but I didn't want to actually bore you guys, so I actually avoided speaking about it. What kind of management and businesses you are getting into, that defines what kind of returns you will get over a period of time. If you get into shady managements and shady businesses, it will come back to haunt you at some point in time. And last one is basically scalability and replicability of particular return over a large AUM. Because you can start, you can have a very small portfolio of 100, 200 crore. You can take a concentrated weight of 7-8% and you can make return in a 3-year period. But when you look at whether it is 200 crore portfolio or a 20,000 crore portfolio, when you look at that portfolio, does it give you confidence that it has scalability? That will reflect on the ability to generate alpha over a period of time. I think I have overshot a lot. So I'll just probably keep this summary and close this session. Thank you.